Yeah, well, first off, I mean, doesn't this feel heavy? And I'm asking that rhetorically. This market feels heavy, and it's overdue. You know, I've talked about volatility a few times, and I want to make a distinction here. When I talk about volatility, I'm not talking about VIX. I'm talking about the peak to trough decline in a market. And the last 19 months, you haven't had greater than a 5% decline in the S&P 500. Excuse me, numbers were slightly off there. The last 14 months. It's been 19 months since the S&P 500 hit its 200-day moving average. Now, you pointed out the NASDAQ numbers, Scott, and yes, the NASDAQ is starting to show technical signs of a full-on correction. I think the S&P 500 is not far behind. And one might say, like I do, well, okay, the value stocks are going to hold up, right? Energy is going to hold up because crude prices are high. Financials are going to hold up because interest rates are high. But when 30% of the S&P 500 is in the top 10 names, and those names are all tech or tech-like, you can't expect the S&P 500 to hold in there. So on Friday, I was on with you, and I said, I think you're going to get a full correction this quarter in the S&P 500. That is mainly because the Fed has really slowed down the amount of cash that they're putting into the system. So you can expect normal volatility, i.e. a 10% plus peak-to-trough decline in the S&P 500 this quarter.
There has been a massive re-rating in multiples, particularly in in those high-flying tech stocks. The high multiple is what I wanted to say, technology names. And if you remember, Brad Gerstner at Delivering Alpha this past fall was telling us that the 10-year was going to go back to pre-COVID levels, which it now is today. January 2020 is where the 10-year was last at this level, and that multiples in those stocks would need to compress by some 30 to 40%. He also said in December, when he was last on this program, that he was starting to nibble on stocks because multiples had come in so much. Well, new at noon, I traded some texts with him today, and he's since tweeting about it now. He says we could still be about 10 to 15% more to go on multiple compression for tech, that Omicron simply postponed the continued re-rating of those multiples for some 30 to 45 days. He said, given the Fed's sloppiness, there's now a risk of retesting November of 2018 multiples. And that was the last time that markets really worried about a Fed policy misstep. Not his base case, what he says, but definitely on the table in the short run. And you can see his Twitter feed, which in the last few minutes has picked up with some more thoughts of his on where the market is. But Steve Weiss, what do you make of what Gerstner's saying? He's been largely right on calling for a re-rating of multiples, that the NASDAQ had to come in as a result, and then it's probably not finished.
Look, Brad, who I know fairly well, is generally right. And he's not one of those tech investors that does invest in these high multiple stocks, who believes that it's always green shoots and it's panacea and nothing can go wrong. But there's a surprise to the market, and the market, it's almost comical in a way that the market believes that momentum can only help you on the upside and not on the downside, that it doesn't occur. So what we are seeing is that re-rating. Specifically, we're seeing multiple contraction, and we're seeing even worse on stocks that have no multiples, so to speak. So, look, I think it continues. I came into today, and because unlike the other panelists, I can actually short stocks, I came in net 50% long today, short the Qs, short the SMH. I covered half those positions. I was short ARKK. I covered all that just because it's so heavily shorted. You can get a very violent bounce. I'm still short TLT. I haven't covered any of that, although I may cover a little because we start to see the rise in rates peter out a little bit today, but I'm not covering all of it. So look, to me, the market has not been through enough yet. Now, we can get bounces along the way, but you still can't justify valuations. And so the justification we've had where valuation didn't matter and where fundamentals didn't matter in terms of the valuation, now they're going to start to matter. And what really hit it today is that you had analysts or strategists or economists come out and I've been very hawkish, as you recall, maybe the most hawkish around, that now it's not enough for them to catch up and say, okay, I'm going to be consensus. Now they come out and say the Fed's going to go 4 times. The Fed's actually going to even have quantitative tightening next year. So you need to see a little bit more of that, because nobody just wants to say, yeah, I agree with you. They say, I agree, but I'm going to go one better because I'm smarter than you. And that's the stage that we're in now. So when you get enough of that through,
you're talking,
you see the market bottom.